Welcome back to Fixed Income in 15. Today I'm talking to Ray Dalio, co-founder and Co-CIO at Bridgewater Associates, and Martina Cheung, president of S&P Global Ratings and executive sponsor of S&P Global Sustainable 1. Today we're going to be talking about economic cycles, financial trends, hobbies, and also what brings our guests joy in life. So a quick reminder that the views of the external guest are the views of theirs alone, and they do not represent the views of S&P Global Ratings. Okay, Ray and Martina, thank you very much for joining.
Thank you for having us.
Thanks, Joe.
So Ray, let's start at the beginning of your career. So you founded Bridgewater in 1975 in the bedroom of your small apartment in Manhattan. So can you talk a bit about where you were personally and professionally before you started the company, and what really prompted you to start your own hedge fund?
Well, I grew up with playing with markets when I was 12. I took money I earned from caddying and other jobs, and I put it in the stock market. And I know that sounds precocious, but it really was at the time. Everybody was talking about stocks, and the people I caddied with were, and I did. And I sort of got hooked on that. And so that was my game. I played that game through college, and I played the game through graduate school. I went to business school, Harvard Business School, and I got out in 1973. And then I worked for for a firm. I won't bother you with all the intricacies, but I found that wasn't great, and that I like to do my own thing. And I also got fired for punching my boss. So anyway, it doesn't. The truth is, we got drunk on New Year's Eve and we got into a fight. And anyway, I found myself on my own, but with a number of clients who liked working with me, and that's how Bridgewater started, 1975. And then so I was in this 2-bedroom apartment. I played rugby with somebody who went to Columbia Business School, and I started it. And when I say started it, it was kind of me and playing the markets, and people would pay me to do that.
Fantastic. So I should probably ask now, do you still keep in contact with your old boss?
We have a great relationship. I really do like the bet. But our paths have diverged. And it was really lucky, you know? It was lucky.
Absolutely.
But of course, the journey from then to now was quite a journey. And I'd say, the best things were the worst things. What I mean is, I remember one time, 1980. 182 that I if you want me to tell you the story, I'll tell you the story. I don't know how.
Go for it. Go for it.
Okay. I had it was a small business. It was hardly anybody, and I had calculated that American banks had lent a lot more money to Latin American or foreign countries than those countries could pay back, and that we were going to have a big debt crisis. And I got a lot of attention for this controversial point of view. And then Mexico defaulted in August 1982, and a number of countries defaulted after that. And so in August 1982, I thought we were going to have a real depression or a terrible debt crisis and terrible economic activity. And that's when Mexico defaulted, and I couldn't have been more wrong. When Mexico defaulted and all these countries defaulted, we began the Latin American debt crisis. But that August 1982 was the exact bottom in the stock market. And so I lost money for myself. I lost money for clients. I was broke. I had to borrow $4,000 from my dad to pay for family bills. That's how broke I was. And I had to let everybody go. And that experience was probably the best experience. It changed my whole approach to decision making. It changed my approach to the markets. It gave me the humility and the fear of being wrong to deal with risk better. It gave me an open-mindedness and also a desire of risk controls, diversification, and so on, that created really the exact bottom in Bridgewater. From that, I mean, there was no Bridgewater. I had to let everybody go. I was at the point where I had to decide: am I going to put on a tie every day and take the train to New York and Wall Street, or not? And I stayed with it. Other clients gave me some money to manage, but that moved, and I learned that the benefit of mistakes, learning from mistakes. So I learned a principle, which is one of my key principles, is that pain plus reflection equals progress. And I learned that humility and that open-mindedness. So that was these experiences from starting at 1975 till now really were great. And the best ones were the best teachers, and the best teachers were the most painful ones.
Excellent. So that's a good segue to my next question. So you've restarted Bridgewater, and since that time, I mean, thousands of hedge funds they've come and they've gone. So what would you say what's the secret sauce behind Bridgewater's success and its longevity?
Well, there are cultural issues of how we are with each other to build a dream together. And then there are investment management approaches. So, let me start with the cultural. To have meaningful work and meaningful relationships through radical truthfulness and radical transparency. What I mean by that is, if you have this, you're on a mission together and you have meaningful relationships. So to achieve that mission, that is a great, great power. And radical truthfulness and radical transparency allows you to deal with the issues in a forthright way. You don't create a political environment in which people can't talk about bad stuff, including people's weaknesses and so on. And so that kind of culture, to produce an idea meritocracy where the best ideas win out, that people accept their strengths and weaknesses. You mentioned that you just took the Principles U test, which is a personality profile test. And that's been very helpful because what I did was I gave the first, let me clarify that. I used other tests over a period of time. I started with Myers-Briggs. I used a bunch of tests. And the Principles U test, which you just took and is free, so I hope anybody who's listening will take it, is a test that is the best of all of those kinds of things created in a new way with great psychometricians. So it's like you say, it's about a 20-minute test and it tells you about you. And what I learned from that exercise was that we would understand where people are coming from, how they think differently. I had 150 management people take it, managers. And I read the profiles, not the test, the new test, but Myers-Briggs back then. And I read the profiles of how people thought, and I didn't actually believe that people actually thought that way, yet 85% of them rated the test on a 1 to 5 scale. They rated a 4 and 5 as reflecting how they thought. And at that point, I realized that people think differently, and how we dealt with each other was very different. Where people before that would be frustrated at how the other person operated. Like the big picture thinker would think about, the big picture, and they dealing with the detail thinker, they drive each other crazy. The big picture thinker would say, you're paying all attention to the details. Don't you get the picture? And the detail thinker would say, your head is in the clouds. You don't know what you're going. Don't you pay attention to the details? And I started to realize, and everybody started to realize, that there are all these different ways of thinking and all of these natures. And so for every strength, there's a weakness. And everybody who is therefore has a weakness if they've got strengths, and to be able to put that together to create a culture that way. So creating an idea meritocracy where there was a meaningful work and meaningful relationships through radical truthfulness and radical transparency was critical. As far as making investment management decisions, there are a few ingredients. There's understanding the power of risk controls. Look, if you lose a third of your money, if you lose half your money, you have to make 100% to make it back. And so what happens is a lot of people make a lot of investment decisions and it goes well, and then something hits them and they go, and the one time is cost them a lot. So to understand how to control risk without reducing your return is key. It's survival. You have to survive in order to get there. Can be knocked out of the game. And so I understood what I call the holy grail of investing, which I discovered. If you can do this, you will, the world will be your oyster. And that is somewhere between 10 and 15 good uncorrelated return streams. Because if you have uncorrelated return streams, you can reduce your risk, if you get, let's say, 15, by 80% without reducing your return. So because they all could be equally good in terms of expected return, but because of how they diversify each other. So taking that kind of approach of knowing how to control risk without reducing return was key. And then systemizing the decision making, writing down principles. I wrote a book, which is Life and Work Principles. And I did the same with investment principles. I didn't put it out as a book yet. But every time I would make a decision, I would write down my criteria for making that decision and then go back and test how that would have worked over time. And that was educational for me. And I learned that I needed to do that even in periods before my lifetime. If big things happened before my lifetime, like the Great Depression, I had to imagine what my system or my rules, how it would perform through the Great Depression, to know that that thing wouldn't happen to me or to navigate it well. And by doing that, for example, understanding that through the Great Depression, we were able, Bridgewater, able to anticipate the world financial crisis in 2008 and do very well in that. So so I would say risk controls by understanding how to balance risk, and then systemized decision making. And I found that when the systemized decision making was written down and put into computers and algorithms that were not machine learning. This was mental learning and systemizing it. When that existed, so that the computer would operate, let's say like a chess game. If I'm a chess master and I'm playing the chess game, I just put it into the computer. I also found that it was fabulous because the computer was strong where I was weak. So the human brain is very good in terms of being creative and all, but it won't process the information nearly as fast, or it has a limitation as to how much it can process, where a computer doesn't have those limitations. And it also doesn't have the emotions that enter into it at some time. I think I probably would have ruined myself emotionally if I'm wrestling with all those things. So those were the ingredients behind this, whatever success I've had. And I'll also say meditation. Meditation has been very helpful for me because meditation gives me an equanimity, a calmness that allows me to approach those things that happen in a clearer. Doesn't mean not emotion. It means that you don't get hijacked by the emotional hijacking. It also makes one much more creative because it connects one's conscious mind to one's subconscious mind, where the creativity comes from. So I would say it's those things have helped me.
Fantastic. And I've got a question for you later on in more depth on the meditation side. So moving on to your book, your newly published book, Principles for Dealing with the Changing World Order, Why Nations Succeed and Fail. I've read it, it's a fantastic book, it's very thought-provoking. And as you mentioned just then in the answer, it provides kind of a view and perspective where we've been, where we are, and kind of what could that mean for us next, both economically and socially. So can you give an introduction to the book and give us an insight into kind of the three main things you identified as being important in the world today?
I did the book. It wasn't intended to be a book. It was intended to be a study for dealing with what was happening today. But as I mentioned to you before, what I learned is that many things that surprised me were things that never happened in my lifetime before, but happened many times before that. So I needed to study history. And the three big things that are happening now are a great deal of debt creation that is being monetized, the production of a lot of money to service that debt. And that means the depreciation of the value of money. And there's changes in reserve currencies. So I needed to study why reserve currencies rose and declined. And I needed to study, then of course, related to that is all the elements behind those economies and other economies. So I needed, because these cycles are big cycles, I needed to go back 500 years. So I would see the Dutch, the British Empire rise and decline with the British pound, the US, and so on. And so I needed to study that history. So the money part was one. So first, financial, creating a lot of debt and monetizing it. Second is the internal conflict. I was seeing that there was a populism developing in the United States and developed world that hadn't existed in my lifetime before. In other words, a great polarity between the left and the right, and political conflict that creates, when I mean populism, populists are people who will fight for a certain segment of the people, and they're populists of the left and populists of the right. And that type of conflict started to emerge, and our whole political environment has become very much more conflict. And related to that, I saw that the wealth gaps and the income gaps were the highest since 1900. Very large wealth and income gaps, producing a disenfranchised population and producing this populism that was producing an internal conflict of the sort we see today. That never existed in my lifetime before. And then the third was the rise of a great power to challenge an existing great power, the rise of China to challenge the United States. The Soviet Union was never a comparable power because economic power is military power too, because you can spend more on military and the like. And so they were always Soviet Union and Russia about 1/12 the size of the United States economically. So but China is different. China is by most measures already almost a comparable power, depending on the type of powers we're looking at. So I needed to study that. So that's what took me back those 500 years. And I saw that the same thing happened over and over again. By the way, for any of your viewers, there's the book, which goes into it in depth. But there's a YouTube video that I put together to try to make it simple, and it's called The Changing World Order. And you could see that picture, and then you dive into the book if you want to. But that picture repeats over and over again. So you see these cycles. There's a debt cycle, there's a political cycle, there's a strength cycle. How strong is a country in these various ways? I measure them in a lot of ways, so you see the measurements. And you could see that arc, and I think it's so important to know where we are in that arc.
Fantastic. So moving over to the credit side. So Martina, as we hopefully move out of the pandemic, at a high level, what are we seeing in terms of credit rating trends?
Well, we came into this year with very positive momentum. We had an economic rebound and very favorable financing conditions. And it won't be news to anybody who's listening that the market generally last year was significantly up. So about 9 trillion in issuance last year, which was over 5.5% growth year on year. Our analysts, Joe, are predicting about a 2% contraction now in issuance for 2022, which really would just put us back to pre-pandemic levels. But clearly, everybody's watching the response of the Fed, inflation, the continued exit from the pandemic, and obviously the geopolitical situation that we see ourselves in right now. In terms of the trends from a credit standpoint, clearly the most exposed sectors would be speculative grade debt and some emerging markets. But we do see from an analytical standpoint that spec grade debt would has largely weathered some of the headwinds, but obviously continues to be somewhat sensitive to the pandemic challenges. So definitely one to watch there closely. That's the view from a very high level, I would say.
Great. So Martina, in Ray's book that we were just discussing, he maps out the historical success of societies that draw on the widest range of people, so providing responsibilities based on merit rather than privilege. But these societies seem to generally be the most sustainably successful. So I know S&P, we published a variety of research pieces looking at the data behind women in the labour force and the impact of the pandemic on specific societal groups such as Black women. So can you talk a bit about these publications and maybe give some high-level takeaways too?
Yeah, I was really struck, Ray, by some of the themes, and you've highlighted them here also. This notion that inequity leads to polarity, which really resonates. And I think we started this about 5 years ago and put the first papers out about 4 years ago for a program that we call Change Pays at S&P Global. And that's really, the objective of it is to look at gender inequity and hone in on areas of opportunity. So there were 2 studies that, amongst many, that really resonated with me. One of them was done, I think, around 4 years ago when we did the launch of the actual program, and it looked at female labor force participation in developed countries around the world, and it examined the extent to which the United States would have had accelerated GDP growth had women in the United States had equal levels of participation in the labor force compared to very advanced countries such as the Nordic countries, for example. And we found that GDP could in fact have been accelerated, and depending on which time period you looked at in the study, you could have had trillions of value in global stock market as a result of that. So that's something that we've continued to sort of delve into. And last year, a lot of people were talking about the unequal impact of the pandemic, if you like, on certainly women. And then we had looked much more specifically at women of color. And there was another study that was done by our US economist, Beth Ann Bovino, which I found fascinating. And it looked at education and career advancement opportunities of Black women between 1960 and 2020. And that study found that had Black women had the same opportunities in education and career advancement as white women, that we could have added over $500 million to US GDP in that time period. So, we really believe that investing in women is an investment in sustainable success. And it's something that we're looking at very closely. There's not just one variable to solving that. I'm sure we could have a whole podcast on that, Joe. But it's something that we like to highlight and continue to highlight in our research and highlight the policies and support programs that could help advance that.
Great, thanks, Martina.
I'd like to jump in there and support
Oh,
that, if I may. What you see through the study of the 500 years, and also I studied the dynasties in China since the Tang Dynasty, which was the year 600, is that you see that societies that draw on the widest range of people and provide them meritocratic support and enablement are the most successful, because you can't tell where the talent is going to come from. There's no, and also it's fairer. So when you draw the largest population and you provide equal opportunity, or as close as that you can achieve, and you create a meritocracy with that, you will have the greatest probability of getting the most talented people. And you will also have a society in which the people believe it's a fairer society, and believing it's a fairer society helps make it a stable society.
excellent. Thanks for that, Ray. So, Ray, how could the findings of the study we've been discussing that you published, looking at where we are in the cycle, potentially impact the bond market and bond investors over the next kind of 5, 10, 15 years?
Well, it's very simple. The value of money. There's two ways of looking at it. When there's a lot of debt, then there's a requirement for paying. But paying can be very easy if the central bank prints the money and makes it easy to pay. So, for example, the actions that were taken by the Federal Reserve mechanistically in coordination with the federal government, and not just in the United States, but in most countries, Europe, Japan, most countries, all countries, meant that the central governments sent out a lot of checks and provided supports, and that the central bank provided backstops or liquidity so that that's possible. And so a lot of buying power. In the United States, about 5 times as much money was sent out that way than was actually required to provide compensation. If you took all the losses of incomes and so on, a great deal more was provided. So that has an implication for the value of money. And so you've seen it, right? Money, when credit and liquidity is available, it causes the prices of goods, services, and financial assets to go up. So that this great liquidity that we've seen, and not only the liquidity itself, but also the capacity to borrow and get buying power, has had the effect of causing asset prices to rise, causing buying power to rise, and causing higher levels of inflation. So I think when we look ahead and we think about credit, we think about what is the probability of being paid back. And so if you have a lot of debt, maybe that's a problem. Or what is the probability of that being dealt with through the creation of money that makes it easier to pay back? So I think we're at an inflection point. I think that there's too much debt. And there's also, if we take pro forma financials of governments, we're going to have continued large deficits. And there's also a political need or desire to do that. Everybody wants to spend money. And this internal conflict requires more of that kind of spending. And so I don't think that you're going to see that kind of restraint so that it'll be paid back much with hard money. And so the question really is for bonds, how does that risk? The risk to me is a buying power risk. I think that investors and most people look at how much money they have, measuring it in nominal terms, and they're not used to thinking about it in purchasing power terms, real terms. And so when and we're now in a tilt, that's going to change. Because as we have higher levels of inflation, the psychology changes. So think about holding bonds or cash in this environment. Last year we had a 7% inflation rate in the United States. And the next year we might have a 5%. Now, if you're holding cash, for example, you lost about those amounts to buying power. So investors' perception of riskiness is changing and will increasingly change. And the amount of money that has to be, the amount of debt that has to be bought, let's say by governments, or you could include the private sector, it's the amount that is offered. So let's say governments have to offer that debt, so they fund a deficit. But if you get bond selling, or you get people realizing what the risks of cash are, and they don't want to hold it, you will get more selling than the amount that equals the deficit. So, and that would cause interest rates to rise, or would put the Federal Reserve and other central banks in a position of having to buy more money, put more money, and do more buying to fund those deficits. I think that that's the kind of environment that we are in. So I think we're shifting in much the same way as the 1970s shifted to this environment in which people are going to be paying more attention to the value of money, and that's going to cause this kind of a shift. So I would be more concerned about that. I would say, like, if you look at real interest rates and interest rates over the period of time, they have had to decline as debt levels go up. That's because there's a debtor and there's a creditor. And central banks try to balance the rewards and penalties to be either. If one is suffering, and they do that by affecting the level of real rates. Since 1980, every cyclical peak and every cyclical trough in rates was lower than the one before it, until you hit zero rates. And then quantitative easing, the printing of money and buying, made up for the inability to lower rates. And so every quantitative easing was greater than the one. And real interest rates fell by 500 basis points. So you look at bonds and you look at credit, and I think they've become ridiculously priced, and people may have lost sight of that. Think about it this way. If you take a bond and it has something like existing rate structure, in nominal terms, you give over a certain amount. How many years does it take you to get back what you gave? And then you start to make money. Depending on the country, it's 50 years or 100 years to get back what you gave. And that's in nominal terms. If you look at it in real terms, you never get it back. In other words, the real interest rates are negative. So you lock in that. And that's because of the amount of debt and the need for operating that way. So I think we've made a secular shift in terms of the value of money issue being the main issue, less than more than the issue of will it be paid back.
Okay, fantastic. So Ray, I'd like to get your kind of two quick viewpoints from you. Firstly, what's your personal view of ESG and sustainable investing? And secondly, how are you approaching the cryptocurrency space?
ESG is, I think, again, a fabulous development that is very popular, that will, I think, attract a great deal of money. However, it is in very much the early stages. And to actually go through the process of defining it better and creating essentially the stamps of approval and going through the mechanics of that will be an evolutionary process. The actual amount of money which wants to go into ESG is enormous. The amount that has actually gone into ESG is tiny by comparison to that. So it's in that developmental process. I think that there's been great advances to being able to look at one country, one company or another, and to be able to actually measure what is their impact in all the dimensions. But that's a developmental process. But what we have is a problem basically for our society in that we don't have enough all-in cost accounting. And so things that we're doing that are detrimental to the environment or in other ways, we don't have adequate charges for. And this is a move in the right direction to have those adequate charges that's beneficial. As far as cryptocurrencies goes, I think we are in an era that one has to look at all currencies. What is money? What is currency? What is money? So a currency is both a medium of exchange and a storehold of wealth. And a global currency is one that you can take from one place to another, so it's portable. And that's why gold, although in Asia also silver, gold and silver through a period of time were the monies because it had that attributes. And there's an era of one man's assets or another man's liabilities. But some of these assets like gold, it's private and it's not a liability. It's that asset. And so I think we're coming into an environment in which there's going to be a competition of what is a good currency. And there'll be that competition will include crypto. It'll include gold. It'll include, I don't know, it could be NFTs and it could be all sorts of, and it could be digital, ECNY, in other words, a digital Chinese currency. They're all going to be competing in terms of that, I think. And this issue of then the printing of money, I think that this is particularly true now because as we look at sanctions are playing a role. Sanctions are, like countries, not just those that have been sanctioned, but those that question whether they could be sanctioned one way or another are thinking, what is a safe storehold of wealth? And if you look at history is really a good guide. The taking of another country's money is one of the great weapons. So like in World War II in Japan, just prior to the war, you always have these conflicts and you have somebody taking the money or make it difficult for access. So in prior to World War II, the United States froze Japanese assets. And so different countries worry that could happen to them. And that's changing the nature of where they're storing their money and how they're operating. So we can get into the pros and cons of crypto. And I think it's almost people pay too much attention to what's fashionable at the time and don't maybe look at one against the other and realize probably they need a diversification of those types of assets. So I would favor a more diversified view of those because sometimes crypto people don't buy gold or gold people don't buy crypto and so on. And there's a certain dynamic. I think privacy is a big issue. It's increasingly so, which is driving people to gold. And but also crypto, it's a ledger. And so privacy can be cracked. And so there are these kinds of issues that are entering into this competition between these alternative types of money.
Great. And Martina, from a credit ratings perspective, how are we at S&P Global Ratings positioning to meet the kind of ever-evolving needs of investors in areas like ESG and cryptocurrency?
Well, obviously ESG has been very much top of mind for quite a few years now, and the explosive growth really took place during the pandemic, I think, and we're forecasting for 2022 that sustainable issuance or sustainable linked issuance in some way could surpass 1.5 trillion. So. Definitely making a dent. At S&P Ratings, the ratings themselves have always reflected ESG characteristics because they look at everything that is material to the credit profile of either an entity or an issue. In the past year, there have been quite a few actions that were connected to climate risk specifically. And that comes in a variety of ways. It can be the damage to real assets, the uncertainty around, what the overall financial implication is, for example, from natural catastrophes and things of that nature. And that's certainly something that we would, expect to continue, given where we are with climate change. And we also have seen a very dramatic increase in issuance related to net zero commitments. So companies who have gone out and said they will be, carbon neutral, net zero by 2040, 2050, various different timelines, and beginning to put, real investment plans in place to affect the change that's needed for that. And obviously that will vary by sector, but definitely a lot of interest in the market around that right now. For crypto, it's a bit more, we'll call it sort of unpredictable, certainly nascent, but I would expect that, as we see more institutional interest in it, and whether it's, as Ray said, for diversification purposes or otherwise, that we could see a rapid acceleration there. And in fact, I think in Q4 of last year, the value of crypto assets actually topped 3 trillion. So it's not tiny by any stretch, but it's still, the 5-6% range of, of overall assets globally. So for ratings in particular, it's a discovery process, I would say, in understanding first how crypto could actually impact the financial ecosystem more broadly. And certainly as institutional interest picks up, that will become more evident. But we're watching interesting use cases more and more. I mean, Ray, you mentioned the risk of using crypto to avoid sanctions. I actually read in the Wall Street Journal, I think, in the last couple of days, that the Ukrainian government has used their crypto exchange in Ukraine, the largest one, Kuna, to actually raise funds for relief efforts, for example. So, we're seeing a lot of different ways in which the technology is being used, and I think getting to a viewpoint on what those new capabilities, whether it's smart contracts, DLT more broadly, can do, is going to really inform us and as to how we move forward with this.
Great. And Martina, just to dive in a little bit further on the sustainable investing side of things, Ray mentioned previously it's growing, but it's still relatively early. So how could ESG and financial markets realistically evolve over the next kind of 5 or 10 years?
Yeah, it is a longer play in the sense that the timeline that most institutions and stakeholders are looking at is that magical sort of 2050 timeline, and various institutions and governments are playing around that, some 2040, some beyond 2050. But the truth of it is, I mean, we see now over half of the world's assets are actually committed to net zero, and that's coming off the back of a very strong year of commitments with COP26 that came up last year, the setting up of GFANZ, the Net Zero Asset Managers Alliance, et cetera, and the Net Zero Asset Owners Alliance. So there is a critical mass of assets, we'll call it aligned to this, the extent to which they explore different themes and go much deeper is, there's lots more conversation that can be had around that. But I think what we're seeing also is the matching of that interest and commitment on the asset owner and asset management side with corporates who are, as I mentioned, actually starting to really put forth more detailed plans around their commitments to net zero and the timelines. And so, I think this is going to continue to spur growth in, the passive funds around ESG. We saw that, I think, triple last year. And certainly, an increasing number of companies looking to essentially finance their transition. I think there's a lot of investor demand. As Ray said, there's a tremendous amount of money that has an interest in being aligned to and investing thematically in this area. And I think there's great opportunity for companies to access that funding. So I think it's not the first or second inning, but it's also not the ninth inning on this. So, we'll call it somewhere kind of in the middle. And, it will certainly develop much more rapidly, I believe, in the next couple of years.
Fantastic. So Ray, share something with you now. My first ever job was at McDonald's. So I was window one of the drive-through. So I was the guy who kind of takes your order. So in a previous episode, Martina shared that her first ever job was working in her family's Chinese restaurant. So you mentioned earlier that one of your first ever jobs was as a golf caddy. So what was that like, and how did it help you ignite your passion for the markets?
And I'll connect that to the McDonald's. So I would walk. Everybody was in the stock market then. I mean, it was one of those things where if you got a haircut, the barber's telling you what stocks he's got. He's asking you what stocks you've got. And so it was that kind of environment. And I'd walk along and I'd caddy, and I'd talk with the people who were I was caddying for about the markets, and then I took my caddying money and I put it in, and then just fast forward. Then when I got in college, I decided that I wanted to trade commodities, and the main reason was they had low margin requirements. So if you're going to make money, you can make more money if you have low margin requirements. And so I was planning on making money, so I was attracted to commodities. And then what happened? And so I went to graduated college. I went to business school and traded commodities. And in 1973, which was the year that I also graduated, there was the oil shock, first oil shock. And I knew something about commodities, so I was hired as director of commodities for Dominic and Dominic. Of course, I never did anything like that, but they wanted some guy who knew about commodities, and nobody from Harvard Business School had ever gone into commodities before, but I was hooked. And then that led over a period of time, by the way, to this McDonald's punchline. So I knew I would deal with hedgers. And the largest chicken producer in the country and McDonald's were both clients of mine. And McDonald's wanted to come out with the McNugget. But the problem was chicken prices were very volatile. And so if they came out with the McNugget, they wanted to keep the menu price stable. And if prices went up a lot, then they would get squeezed. And it occurred to me that the economics of a chicken is there's a chick, and then there's grain that you feed the chick. And so if you buy the grain and you could hedge it, you could fix the price of the chicken. So I went to the chicken producer and I introduced them, and we created a hedge so that McDonald's could have chicken McNuggets at a fixed price. So that's my kind of long-winded story and partially answering your question, but also it's kind of, in a sense, a funny story about the economics of delivering McNuggets when you were at the window to create the stable pricing.
Great stuff. Martina, one for you. You've met with, over the period of your career, a lot of competent people, kind of internally at S&P Global and externally. So what kind of habits or personality traits do kind of the best people you've encountered share?
There were a few that I could identify. One and I've believed in this my entire career, is the importance of integrity. And Ray, somebody was speaking with you last week and quoted you as saying that integrity is the absence of duality, which I parked in my brain and will keep there. I thought it was very appropriate. But there are a couple of other things that I think are important. I think it's very important to be intellectually curious, to listen, because I think listening leads to inclusion, and so those would be the things I would highlight.
Perfect. So Ray, I understand you practice transcendental meditation, which you mentioned before. So for the uninitiated, like me, basically, what is transcendental meditations? And what are the benefits, and how do you use the technique on kind of a day-to-day basis?
It's really a very simple thing, nothing exotic about it, but very powerful. It is the process of repeating what's called a mantra, which is a sound. For example, something like Om, but in your mind you repeat it. And in the process of doing that, that takes you from your thoughts, which are, when you try not to think, you're still thinking. It eliminates that because you're focusing, when you're saying this Om in your mind, you can't be thinking about other things. And then it disappears. And then you are in a state of transcendence. You're transcending essentially to your subconscious state, which means it's not like sleep. But it's not like awakeness either. It's this quiet state in which you're really almost not conscious. And then it's a transition to your subconscious mind. We have a conscious mind and a subconscious and an unconscious mind. Well, this takes you into the subconscious mind. And the subconscious mind, a lot goes on in the subconscious mind. A lot of creativity, that's where it really comes by. Like if, for example, you take a hot shower and great ideas come to you, but you try to be creative and you can't muscle it, it just kind of flows from that subconscious mind. And it kind of creates an alignment and a peace. So that it gives it gives people an equanimity, a calmness. So it's very relaxing. It's very conducive to being creative. And it gives you that kind of equanimity. So that's what it's like. I would attribute whatever success I've had more to that than any other thing. Although I do agree with the what you were saying before, Martina, because if the curiosity, and I think what you also said, which I would put it in my words, that open-mindedness and that humility that lets people understand, that gives people the capacity to take in, is incredibly powerful. Once you really understand, I think that whatever success really comes more from how you deal with not knowing than anything you know. Because you can only know a small percentage of what you need to know. But all around you, you can find ways of knowing what you don't know and dealing with it better. And so I support what you said. Those are good elements.
Great. So Martina, as president of S&P Global Ratings, you've got obviously a very big responsibility and most days a very packed calendar. So taking yourself outside of the pressures of work, what things, activities, or experiences in your life currently bring you joy?
Well, I'd say kind of maybe not quite outside of work. I do a lot of work with our employee resource groups, and I've been involved with probably 4 of them pretty heavily since I joined S&P about 12 years ago. And that's really fantastic because it helps build that relationship that's not purely kind of to do with, executing a task or, specific role. And then outside of work, I have probably 3 or 4 charities that I work with, one that I'm on the board of, that just gives me a chance to give back. United States has been very good to me. And I think it's important to support local charities. So that gives me a lot of fulfillment, let's say. And then my joy comes with my toddler. And I was wondering, well, where he was talking about transcendental medication. Medication maybe because you need that with a toddler, but meditation. If I can't forget the nursery rhyme and it keeps going over and over in my head, do I achieve a transcendental state? I'm not sure, but I definitely get a lot of joy.
No, fantastic. That's great. And Ray, same question to you. What things, activities, or experiences in your life currently bring you joy?
Well, I mean, there are many things, and I'll touch on them in a second. But I'm in a life arc. There's a life arc, right? And where I am in my life arc very much affects my whole approach to many things. I think that, in the first third of one's life, you're learning and you're dependent on others. You get out of school, you're on your own, you build a career. In the middle part of your life, you're trying to be successful, and others become dependent on you. And then you make a transition into the third part of your life. And in that part of my life, that's a compelling thing. I want to help people be successful without me. I want to pass along whatever I've had, whether it's philanthropically, it's money, maybe it's other things that can be helpful to people, and that's an arc. And one of the other aspects of that arc, which is fantastic, is grandkids. So I'm loving my grandkids; they bring me a lot of joy. But I'm also I'm very curious, and I have and I can go all over the world and with all different people and get exposure to everything. And I certainly love my game, the game that I started when I was 12, which is I love knowing, trying to figure out what's going on and being able to bet on it. And so I do that. And I'm at a stage where I've transitioned the building and the development of Bridgewater to others, and I can get to mentor them while I'm playing my game. So those are the things. And then it's eclectic. Yes, philanthropic. And then also I love ocean exploration. So that's the thing. I built a research ship that I give to scientists, and I get to see what they do. And those are the things that excite me. They bring me joy.
Fantastic. So Ray, another one for you. You've met with a lot of influential voices in government, in business throughout your career. So are there kind of one or two individuals who you've met over the years who've just struck you as particularly impressive or insightful?
Oh, yeah. I mean, many of them. Ones that come to mind. Lee Kuan Yew, the founder and builder of Singapore. What a man, having balance, vision, independent thinking, and delivering a culture, not just success. I can go on at length. Paul Volcker became a good friend of mine, and the courage, the quality of his character, his beacon. Henry Kissinger. These people I've gotten to know intimately, and so on. All of them have humility and a vision, and then there are many others, but top of mind, those are three that have I look at as heroes. And by the way, some of the heroes, those are prominent people who run big things and so on. I should also say that there were others. There was two of my sons were in scouting, and there was a scoutmaster who and he humble man. He had a garbage truck and he collected refuse, and he did that. And he is one of my heroes because of his character and what he did and the giving. And I see this among very, very humble people who are brilliant and also very giving and very contributed to societies. You wouldn't know their names, but I would say I know as many of those as those that you would say are extremely successful. Successful in, let's say, how much money or power they've gotten. But there are many people with money and power who are not, may not hold a candle in terms of what I would define as the total success of people who've impressed me.
Absolutely. And Martina, do you have any professional role models? So that could be people you've met or people you just admire from afar?
Well, my parents were and probably always will be, the original role models. The work ethic that I got from them is one of the most enduring characteristics I think I have, and I see that with all my siblings as well. But I wanted to, March 8th is International Women's Day, and to be honest with you, there are probably countless women who, have forged a path in their careers that have given the platform and the opportunity to people like myself to succeed as well. So I'll say my inspiration comes from them also.
Great. So Ray, 2 more questions for you and then we'll wrap up. You've had a successful career, to say the least, spanning kind of 50 years. So if you woke up tomorrow and had to do it all again from scratch, would you do anything differently?
Well, it's a tricky question because on the one hand, the joy of learning and making mistakes is really the essence of your question. Of course, if I knew what I know now, I wouldn't have done some of the things I did in the past. And so I wouldn't do those things. But then the way I look at it is it's a journey of that. It's a never-ending journey of that. So yeah, I've fallen, I've scraped, I've gotten beat up, I've succeeded, and whatever. I made mistakes. If I had a life that didn't have those mistakes, would I be better? I don't know. So the journey to me is I can't imagine a better journey, really. Would I eliminate the mistakes? I don't know that I would.
The journey is the destination. So,
it's the ups. Yeah. It's the ups and downs. You know what I mean.
So last question, Ray, last one of the whole episode goes to you. So I usually interview influential individuals from the world of finance and economics. So thinking about everyone you've met throughout your career, so kind of anyone really, politicians or investors or kind of from any sector or field, who would be an interesting potential guest that I should invite to an upcoming show?
Well, it depends what is the area that you want to cover. There's
But it could be
so
from the
many
financial side, finance, economics.
So there are so many dimensions, how people think. You might invite somebody like Adam Grant. It depends. I think world affairs right now, Henry Kissinger, right now, and the ability to step back. This man is 98 years old. His brain is as sharp as you could imagine, and his perspective is both as a historian and a practitioner. So I would say Henry would be great. They're all what's going on in neuroscience and you could life. I would say it's interesting. David Sinclair, if you're interested in life cycles, meaning how health evolution. I would say Dawkins. So anyway, it depends on what your subject is. There's so many different things, I don't know what you're trying to capture.
Yeah, there's some great names in there. People like Kissinger would be great, but maybe for the future. So that's it. Thanks very much, Ray. Thanks, Martina, for your time today. And for everyone watching and listening, wherever you are, see you next time on Fixed Income in 15.